Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Okay, here's the 9-step process to make sure that you fully understand what key person insurance is and the process to think about and go through whilst you're considering this. So to keep it simple, what is key person insurance? It's either a life insurance or a critical illness policy taken out by the business on a key individual with the business as the beneficiary. So the company owns the policy, it's insuring one of its team members, and if that person, that team member was to die or become critically ill, the company would receive a payout as a lump sum, and that's it. And that money will be used, as we'll talk about later on, to cover the effect and the impact of that person becoming critically ill or dying and the effect leaving behind in the business. So this isn't about replacing the person emotionally, it's about protecting the business financially. So step 2, who is a key person? A key person is someone whose absence would cause one of the following: a loss of revenue, loss of relationships, loss of operational leadership, loss of lender confidence, or loss of strategic direction. There's plenty of examples of these. These could be, individual directors of companies, sole directors making all of the decisions and the running of the company. The key lead revenue generators, property deal sources, developers managing projects, business owners signing personal guarantees, and specialist operators. In many SMEs, the owner is the key person, but it can be somebody else, maybe not the owner. So that's something to think about. Who is the key person? The easiest way to think about this is when someone goes on holidays for 2 weeks, how does the business really suffer? Just with them being out of the office or not doing their job, it does that impact the profitability of the company? And can you not wait for them to get back into work? So step 3, what financial risks does it protect against? Without key person cover, a business could face the following: an immediate revenue drop, loss of major contracts, difficulty servicing debt, loan covenant breaches, project delays, staff redundancies, struggling to recruit a replacement, and reduced business valuation. In property specifically, development funding often depends on individuals and their experience. Lenders back people, not just assets. Personal guarantees can create exposure, and refinances may stall. Ultimately, when lenders lend, they lend against the balance sheets, but they actually are backing the people against it. So oftentimes when we look at lending, people will say, well, they're lending against the asset. They are lending against the asset, but they're also lending against the person behind the business. Who is the person? What's their experience? What's their personal net value and their net balance sheet? What do they have from a back end? And if there's something goes wrong, is there ability for us to get our money back? That's the key. That's all they're looking for. And when we talk about businesses with a key person disappearing from the business, how does that impact relationships, confidence in the business? Do people think, they're not going to survive without that person? They're the key person there. They're the core. They're the one that drives that business forward. So if you've got someone in that business, or if you know of another business, if you're doing your own risk planning for your own business, look at some of your key clients, your key suppliers, and do they have individuals that are key to those businesses? And if something happened to them, what impact would that have on your business? Step 4, why it matters for property investors and developers. So for property investors, a lot of the time now we see investors doing deals with multiple different investors. So they'll have JVs going on with lots of different people. So they'll have multiple SPVs. but they might be the one driving them forward. They might have their own SPV. They might have their own SVP, another SPV with a life partner. They might have another one with a business partner. They might have another one with investors, but they are the one sole director that's driving those decisions. So those are really key people in those multiple businesses. They may have provided personal guarantees across the portfolio, and something happens to them and things go south, then the bank will come calling. Debt servicing depending on one income stream. So if that person is the sole income provider and they are funding the debt in the short term, then that can cause problems. And development projects tied to a single decision maker. Again, this is huge in terms of developments. So thinking about if something happens, who would start servicing this debt? Who would start negotiating with the lenders? Who would finish the project? And who would maintain investor confidence? Now, obviously, I know we invest ourselves, and I know if something happened to me, that my wife wouldn't be particularly comfortable with understanding all of the nooks and crannies and the ins and outs of investing and the projects that we do. So it would be important that in my will, she understands, and I've put in their letter of wishes and who to go to for what situation and what scenario, and who should be contacted for support in different elements of it. So trying to make it as easy as possible. Plus there's insurance in there to make sure that if anything does happen to me, the debt can be cleared so that there's no immediate risk that she has to deal with in terms of servicing debt or dealing with lenders, etc. That is all being done on her behalf. So those are the things to think about. Step 5 then would be, how is cover structured? So when we're talking about key person within a business, this is slightly different. So this isn't necessarily debt cover. So you'll have mortgage debt cover for your mortgages or your commercial mortgages, in which case they can line up the length for that term, because some banks will insist on key person cover if they can see that there's somebody that's driving the business. But also for key person cover, the key things that they will look at is that individual's contribution towards profits. How much of the loan exposure is included in that? They look at the cost of recruiting a placement. So if you can imagine someone really key to the business and they're on £100,000 a year and they disappear, they need the cost of recruiting somebody. So if you've got to bring someone in short term to help with that, likelihood is the salary is more than £100,000 a year. Plus there's the recruitment costs and the fees and the time it takes to find a suitable replacement. All of this is a cost to the business. So another way that they work this out potentially is a multiple of salary or salary and dividend, depending on how that person's remunerated. It's structured in the way that the business pays the premium and also the business receives the payout on that money. And then the tax treatment on that will depend on the purpose of it and the structure on it. And that would need input from your accountant or your tax advisor to make sure it's set up in the correct way. Step 6 to think about would be whether you go for life insurance only or life and critical illness. Life insurance only protects against the death of that key person and will only pay out if they die. Whereas life and critical illness cover will cover serious illness that prevents that person from working. The key things are heart attack, stroke, cancer, MS, etc. So if they had one of those, plus a whole array of others to stop them coming back to work, then it would pay out and the business would receive a lump sum, and then they could use that money to find a replacement and to start protecting the profits of the business. In many cases, critical illness can be more disruptive than death from a business continuity. When someone does die, people, you have to draw a line in the sand and realize that life goes on without that key person. But sometimes if they have a critical illness, are they going to make a recovery? Are they not? And how long is that going to take? And it takes a bit more time to make the decision with a line in the sand if that person is going to continue in the business or not. So that's something to consider. Step 7 is when business overlook it. Oftentimes we'll hear things like, we're too small, we'll sort it out later, it won't happen to me, we've got cash reserves, and the business would just stop anyway. And so there's plenty of answers to all of those questions. Cash reserves disappear faster than revenue replaces itself. You burn through that quickly. If you've got nobody, if someone's contributing huge amounts of sales to your front end, if that person disappears and they're responsible for 90% of your sales and they go away, sales stop on the front end, eventually cash will run out on the back end. And it's the lack of cash that kills most businesses, not the lack of equity or value. And so this is something that really people need to understand. So this policy effectively is short-term cash injection to support the cash flow in the business whilst it's in a bit of disarray, having lost a key member. Step 8 is when key person insurance makes more sense. So any businesses that have any debt, any businesses that are reliant on one or two key people, property developers, growing companies that are looking to scale, businesses that have investor backing, they likely will want to see this policy in place because they are backing the people to grow the business, and they'll want to make sure that they are protected and their investment is protected. And any companies signing personal guarantees. If the business would struggle financially without that individual, it's worth assessing for key person insurance. And then finally, step 9 is the key difference between key person insurance and shareholder protection. We see a number of people have shareholder protection in place or potentially relevant life plan. A relevant life plan is a death in service policy for any employee of a business. Shareholder protection is an insurance payout to cover the shareholders of the company. So if they were to die, their family would receive the value of their shares, and then the company would buy back the shares for a set price agreed at the time. Whereas key person protects the business and the longevity of the business and the lifeblood of the business, making sure that it has an injection of cash to replace that key person, to protect the profits in the short term, to ensure that the life goes on past that key person. So it's just those slight nuances between that and shareholder protection, where shareholder protection actually protects the ownership structure and not the business. So hopefully that's been helpful, really trying to break down the 9 key things to consider when looking at key person insurance and whether it's something that you need to consider for your business. Key person insurance isn't about being pessimistic, it's about being responsible. If your business depends heavily on you or one or two other key individuals, then protecting that dependency isn't optional, it's strategic. If you're running multiple companies, property SPVs, or development projects, and you're unsure on how exposed you are, it's worth having a conversation. Protection planning shouldn't grow alongside your business, not after something happens. Thanks for listening. I'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.